Mr. Kathuria, thank you very much for your time. Let's talk about the thing which has excited the street in your results, which is price hikes. How much price hikes have been taken in the company in the first quarter and if July as well? And how much more are required to restore your margins to last year's levels?
Regarding the price hikes, actually, we need to start with the raw material side. We had seen that in quarter four of last year, the raw material prices had started hardening. So in April, we had taken a price hike, which was, in quarter one, we saw that the raw material costs had gone up further by 3 to 4%. So correspondingly, we had taken a price hike during the quarter one. And we have also taken another price hike in the month of July because we expect that maybe the raw material prices will further harden. So depending on two things, one is how the raw material prices will move. The other is the ability of the market to absorb or our ability to pass on to our consumers. So these two factors would definitely determine how much further price hikes we would be taking.
Yes, point taken. But given the fact you are pointing to the possibility of raw material prices going upwards from here on and you being open to taking more price hikes, could you perhaps give us a bit more color? What could be the range of that price hike? Any initial indications?
As I mentioned earlier, in quarter one, we had taken a price increase of 1.5 to 2%. This was good enough to kind of mostly pass on the raw material impact, but we have also been working on our efforts of premiumization and also improving our operating efficiencies constantly. So this also helps negate some of the impact of the raw material. Further, in quarter two, there is an expectation that the raw material prices would further go up somewhere in the range of 5 to 6%, but that we will have to watch very carefully. And depending on that, we would be further, if any, we will be taking some price increases.
Right. What's the current net debt level at the company, and what have you been guiding for is a stable debt environment and perhaps going towards the declining side next 2-3 years to become debt free? Are you on track on that now?
Our net debt at the end of the quarter, June 24, is at 3832 crores. This has reduced by almost 18% if I compare it with the March 23 levels. And we are working on a constant deleveraging plan. We hope to accelerate it going forward. Our cash accruals as well as profitability looks good in the coming few years. So we would definitely work towards further deleveraging. Our net debt to equity has also come down to a level of 0.8, and this is quite good. And even the net debt to EBITDA levels are standing now at 1.76. So these are good numbers to have, and we would be working further towards improving them further.
Sure. I also see that your subsidiary revenues have seen a substantial drop in terms of revenues. Mexico operations are under pressure. Why is that?
So both our subsidiaries, Cavendish Industries as well as JK Tyre Mexico, are doing quite well. In fact, in Cavendish Industries, we have again registered very good numbers for the quarter. This is absolutely in line with the parent company, whether it is in terms of the top line or even on the EBITDA margins. So things are looking good. We will have to watch out only for the same factors as we are looking for into the parent company. So nothing specific for the Cavendish. We have been able to, we had taken up an expansion program last year, and happy to inform that the capacities have got commissioned and we are being able to utilize them quite well. And this will also be very useful once the CV industry, which is right now a little sluggish, but we expect that the CV industry from quarter three, post the monsoon, would show a smart recovery, and the capacities that we have put into place will come very useful for that.
Right. Okay. Also tell us, how's your pricing power panning out, especially after the EPR impact?
Yeah, so the extended producer responsibility, the impact for that, we have already decided that from May onwards, it is a pass-through. Whatever is the cost, which is roughly anywhere between 0.7 to 1% of the overall cost. So that we have decided to have it as a pass-through cost, and we have charging it into the replacement market from May onwards.
Thanks for that. Time now